Every single day you're just hit with this like tidal wave of information, right? Emails, news, social media. It's like trying to drink from a fire hose. And the real trick isn't just getting the data, it's figuring out what actually matters in all that noise. Now, picture that exact same challenge, but cranked up a notch and applied to something super critical like complex financial statements. So today we're doing a deep dive into something really vital, but maybe a bit overlooked in finance, the auditing of financial statement disclosures. What we want to do is unpack why these disclosures have gotten so important, some of the, unexpected hurdles they throw up for auditors, and how this big international body is trying to make it all clearer. We're basically aiming to give you a shortcut to understanding this complex but honestly pretty fascinating area. Might even change how you glance at the financial news.
That's absolutely right. While most people, understandably, focus on the big headline numbers, revenue, profit, assets, the notes or disclosures that go with them, they're a totally integral part of the financial statements. Often, they're really the key to understanding the full picture of a company. They give you context. The numbers alone just can't. Yeah, without them, you're honestly only getting half the story.
Okay, so if these notes are that fundamental, when we talk about disclosures here, we mean all that extra crucial info packed around the main statements. And auditors, they have to give an opinion on the whole set of financial statements, right? So that must mean the notes, these disclosures, are definitely included in that overall look.
Oh, absolutely included. They provide vital extra detail on balances, transactions, all sorts of relevant stuff. In fact, ISA 200, that's the international standard on auditing 200, sort of the bedrock standard for auditors, it explicitly says financial statements include related notes with a summary of significant accounting policies and other explanatory information. They're not just like an appendix. They're core to the whole thing.
Right. And to make this, more concrete for everyone listening, these notes can cover a huge range of things required by IFRS, the International Financial Reporting Standards. So first, you've got your quantitative disclosures. Think numbers, breakdowns, detailed looks at property, plant, equipment, or maybe intangible assets, lease obligations, financial instruments, also stuff like for listed companies, showing where revenue and profit actually come from, geographically or by business segment. But then, just as important, you've got qualitative disclosures. These are more descriptive. Things like explaining the company's main accounting policies or pointing out areas where management had to make big judgments, maybe why policies changed.
Yeah.
They also confirm if the going concern idea holds up, basically, is the company likely to stay in business?
A critical piece of information.
Or if there's serious doubt about that. You also find details on deals with related parties, maybe explanations for big write-offs like impairment losses. It's really getting into the why behind the numbers, isn't it?
It absolutely is. The narrative context.
Okay, so disclosures are clearly super important, always have been in a way. But why is the IAASB, that's the International Auditing and Assurance Standards Board, why are they suddenly paying such close attention now? What's shifted?
Well, the big driver is that the IFRS requirements for the disclosures have just gotten significantly more onerous lately. They've really grown dramatically in both scope and complexity. Imagine like a detailed instruction manual that suddenly got twice as thick, not just with more steps, but with way more complex subjective details involved. Their own exposure draft back in 2014, the one called Addressing Disclosures in the Audit of Financial Statements, it nailed it. It said, over the past decade, financial reporting disclosure requirements and practices have evolved. They now provide more extensive decision-useful information that is more detailed and often deals with matters that are subjective, such as assumptions, models, alternative measurement bases, and sources of estimation uncertainty. That shift to subjectivity is really key.
So that evolution creates this kind of weird situation, doesn't it? The more info companies give out to be transparent, the harder it actually gets for auditors and maybe investors too to see what's really crucial. It's like searching for that needle in a haystack, but the haystack itself is made of, potentially useful information. That sounds like a major headache for both the companies writing these things and definitely for the auditors checking them. Okay, let's dig into that first big hurdle for auditors, this information overload thing, and figuring out materiality. How do auditors cut through what sounds like just a massive volume of disclosure?
Yeah, that's a huge concern for the IAASB. Sometimes there genuinely is too much disclosure. Companies might disclose stuff that's not even material, making it incredibly hard for anyone reading it to focus on what actually counts. It's that overload you mentioned. For auditors, this takes serious judgment. A company might think, okay, full transparency, let's put everything in. But kind of paradoxically, they can end up hiding the critical stuff in plain sight.
Right.
It's not just too much info. It's the way it dilutes the important bits. And tied into that is the difficulty of applying materiality, especially to the qualitative stuff. Materiality is basically, would leaving this out or getting it wrong change a user's decision? How do you put a number on the importance of, say, a change in accounting policy description? It's qualitative, but it could be massively material if it changes how you view the company's stability or choices. The IAASB actually looked at giving auditors guidance to help them figure out early on at the planning stage what could reasonably be expected to influence the economic decisions of users.
Wow, okay.
That would really help zero in on what's material, whether by its nature or its dollar value, and plan the audit work better.
So if companies are genuinely trying to be transparent by giving more detail, is there a risk they're, kind of shooting themselves in the foot? Could auditors actually miss something vital because it's buried in just too much less relevant stuff? Sounds like a new kind of transparency problem.
Absolutely. That's the heart of the paradox. Auditors aren't just looking for missing pieces anymore. They're also battling this flood of data that can almost camouflage the really crucial insights. Transparency, in a way, becomes its own kind of fog, needing an even sharper focus from the audit team.
And what I find really interesting here, you mentioned not all this info comes from the usual accounting systems. That must add a whole other layer of complexity, right?
Well, it really does.
Yeah.
That's another key point the AAASB raised. A significant chunk of this disclosure information, quantitative or qualitative, it's often pulled from systems outside the main general ledger.
Like what kind of things?
We're talking forward-looking statements, descriptions of complex models used for fair value calculations, details about risk exposures, often quite narrative complex stuff. And this causes a few headaches. One big one is internal controls. A system outside the normal accounting flow might not have the same rigorous checks for completeness, accuracy, validity.
Right.
For example, info on financial instruments might come from the company's treasury department. Their systems and controls could be very different, maybe less robust for reporting purposes than the main accounting function.
So different risk levels.
Yeah, exactly. Think of it like comparing a critical file on a secure company server versus one on someone's personal drive. The risk profile changes. Controls might be weaker, leading to higher audit risk. This is especially true for one-off disclosures, maybe explaining a big impairment loss. There isn't the same routine documentation you find in accounting systems, so getting enough good audit evidence can be genuinely tough.
Wow, that's a huge point. So you're saying some of the most critical, maybe forward-looking info could be coming from the parts of a company's systems with the weakest controls. What does that mean for how reliable that data is if auditors can't lean on the usual internal checks?
It means auditors have to dig deeper, basically. Apply more professional skepticism. They can't just rely on automated controls working perfectly. They often need to do more manual testing, corroborate information from different sources. It definitely shifts the risk assessment and the work involved.
And then there's the third big challenge you hinted at, timing. You said these disclosures often land really late in the audit game.
They often do, yeah. The IAASB specifically noted that management frequently prepares disclosures very late in the process. So when the auditor is doing their initial planning, the draft disclosures often just aren't ready yet. Which means auditors can't really plan the detailed work on them until much later. That naturally increases audit risk. There's just less time to properly assess the risks tied to those disclosures and do all the necessary tests, especially for the really complex or subjective ones, like financial instruments or those tricky fair value measurements.
Like trying to cram for an exam the night before.
Exactly. You're much more likely to miss something important under that kind of pressure.
Okay, so wrapping our heads around all these challenges, what's the path forward? The IAASB isn't just pointing out problems, they're actually proposing solutions, right? It's good they're not just identifying issues, but offering, actual guidance.
That's right. Their main aim is to give auditors more guidance, to help them focus properly on disclosures, and crucially, to encourage looking at them earlier in the audit. They're even proposing tweaking the definition of financial statements within the auditing standards, the ISAs, to really hammer home that disclosures are a core part of the whole package.
So redefining the basics almost.
In a way, yes, elevating their status formally. The proposed changes involve adding new application material to the ISAs. The goal is to first amend financial statements to clearly include all the auditable disclosures notes, face of the statements, stuff incorporated by cross-reference. Second, really emphasize planning enough time for disclosures, just like you do for account balances or transactions, and thinking early about any significant new or changed disclosures.
Makes sense.
Third, push auditors to discuss disclosure matters with the company's governance, like the audit committee, especially during planning. Fourth, highlight management's duty to get relevant info to the auditors early. And finally, provide more concrete examples of what misstatements and disclosures look like, and make it crystal clear that all identified misstatements, no matter the type, need to be tracked and evaluated for their impact.
And these specific planning improvements you mentioned, they sound like they could really shift how auditors approach this day to day. Things like better guidance on understanding the company and its controls related to disclosures, assessing risks, including thinking about materiality for non-quantitative stuff too. Also, making sure disclosures are discussed in team meetings about potential misstatements, including fraud risk. That seems important.
Very.
Plus, integrating the checks for presentation and disclosure, accuracy, completeness, classification more consistently with how they check account balances. And giving special attention to disclosures where the info doesn't come from the main accounting system and the evidence needed for those. And finally, clarifying that the nature of potential misstatements and disclosures, especially the non-quantitative ones, should shape how auditors design their tests. It really feels like a broad effort to pull disclosures right into the main focus of the audit, from start to finish.
It absolutely is. These proposed changes aim to formalize what many experienced auditors already know deep down. Disclosures aren't just a final check. They're a critical area needing deep understanding, careful risk assessment, and solid evidence gathering right from the planning stages. It pushes auditors to look beyond just the numbers and really evaluate the whole story being presented.
Wow, okay, what a deep dive this has really been. We've covered how financial statement disclosures have ramped up in importance and complexity, the pretty unique challenges auditors face with them, and how the IAASB is stepping up with clearer guidance to try and manage the associated risks. It's such a critical piece of the puzzle, often hidden from plain view for most people, but totally fundamental for reliable financial reporting.
Indeed. And while disclosures have certainly gained prominence, auditing them well is, as we've discussed, genuinely difficult for various reasons.
Yeah.
The guidance the IAASB developed, based on a lot of public input, is really aimed at giving auditors practical help. The ultimate goal is to reduce audit risk by making these complex notes more, understandable and verifiable.
So, thinking about all this, knowing just how much vital information lives in these notes and that it's subject to such intense yet tricky audit scrutiny, what new questions does that maybe spark for you listening now about how you look at financial information or really any complex information you come across? Are you digging past the headlines, looking into those details, even when they seem buried in the fine print? Something to think about.